Today I'm sitting down with Brandon from Reach Home Loans. He's a lender here in South Florida. We talk about affordability, the lending process, and at the very end, he's gonna tell you the number one mistake that buyers make when buying a property in South Florida. Let's get into the conversation. All right, Brandon, what's going on, man? We're gonna go through like three main sections, just one quick section about understanding the lending process. Then we're gonna go into a little bit more market specific stuff and affordability. And then we're gonna just go into like some expert advice at the end. So to kick us off here, what are some of like the biggest misconceptions that you see that people have about, you know, getting a mortgage here in South Florida specifically? Like, is it important to use
specifically? Well,
yeah,
I would say this is most of our business, or I would say all of our business is Florida. Right, I'm licensed in other states, but Florida, let's call it Florida in general, which would apply to South Florida. I'd say the biggest misconception is that you have to put 20% down. It's crazy how many people think that's actually a requirement to purchase a property, which it's not. Especially if you're a first-time home buyer, you have a lot more options when it comes to minimal down payments. You know, 3% on a conventional loan, 3.5% on an FHA loan. I would say the average buyer that we work with is putting down 5%. I mean, we have clients that put down 20% or more, but those are usually someone that's buying their second home or their third home. They've been through the process multiple times. But with first-time home buyers making up a large portion of the buyers in today's market, the lower down payments are a lot more common. So I'd say that's the biggest misconception or misunderstanding of what to expect with the home buying process.
And while we're on that topic, big banks nationwide versus like a local lender. I know that's kind of a big deal here in South Florida. What's your take on that?
Yeah, I agree with that. I mean, I think the big thing when it comes to the quote unquote big banks, as you mentioned, right? Wells, Bank of America, Chase, so on and so forth. I mean, there are local branches where there might be a good loan originator working there. I think the problem is that they don't have control over the process. So as good as the person working at the company may be, right? Because a big thing you hear is communication, right? There's communication breakdowns often when it comes to the banks because there's so many more people involved. It's not just that front person, right? That's my role, right?
Yeah.
In the
communication train, right?
And because they're outsourcing some of the process, they lose control over it, which is a big issue, which is why banks have such a bad name when it comes to mortgages in a lot of cases. Where working with a local lender, most local lenders, and I think by local lender, what you mean more than local is you mean like more like a direct lender, right? Where it's the person, not a bank, right? It's nice if they're local physically, but you can have a bank, originator who's local technically, right? So it's more just the person is, that's all they do, mortgages, and they work for a lender like we are, where we have control over the process, right? We have control over processing, underwriting, closing, funding, where we can close a loan in 8 calendar days, but the bank is going to be 30 plus days, right? No matter what, because that's just how they operate. They don't care. They don't look at you as an individual in most cases. You're just another loan number to them.
Right. Okay.
And so it's not, hey, this has to be a quick closing. It's, hey, no, we take 30 to 45 days. That is what it is. Regardless of you wanting to close in 2 weeks, it's just not going to happen, right? That's what you run into with the bank. So, they get a bad name because of that. Like I said, though, you can have a good loan originator at a bank, right? But the bank itself is just such a bad reputation when it comes to lending that it affects that good loan originator.
Makes sense. So if somebody was looking to get pre-approved, just kind of a broad term of the whole pre-approval process before purchasing a home, like what is a brief description of everything that they're going to have to go through with you guys in order to get that done?
Yeah, I'll give you our process. Every process is different when it comes to getting pre-approved. It should be the same general outcome of it, right? But we always start off finding out what their home buying goals are. And by that, I don't mean I'm looking for a 3-bedroom, 2-bath home. I mean, what's your reasoning that you're wanting to buy, right? Are you currently renting and you finally feel it's time to stop paying your landlord's house off and it's time to pay your own? Are you living with your parents and you're trying to get out of that property? Are you moving from, one part of Florida or out of the state to a different part for work and now you need to find a place, right, that you're going to own? Right? There's different reasons why people are doing it. Maybe they have kids and they want to be in a specific school zone, right, for their kids. So try to understand what their reasoning is for wanting to buy because that's what we try to touch on throughout the conversation, right? And understanding it's not just about, like I said, it being a 3-bedroom, 2-bath or whatever you're looking for. So we'll get what their goals are, try to get an understanding of where they want to be payment-wise. some people don't know, right? Maybe they went online and saw a house they liked for $500,000, and on Zillow, for instance, and they looked at the payment calculator, which is typically inaccurate,
Yeah.
and they're like, "Oh, yeah, I like a $500,000 house because it's going to give me a $1,500 payment." Well,
Absolutely not.
we try to help them understand what to actually expect if that's the price point they're trying to be in, right? So is it the price point they want to be in, or is the payment range they want to be in? So we get a full, hey, you said 1,500, for example. Is that what you pay in rent right now? Is that where you want to stay around, or are you comfortable going higher than that, or do you want to be lower than that, right? So we'll have those conversations around either payment or purchase price. Some people are like, I'm good. I don't really care what the payment is. I know for sure I want a house at this price because those are the types of homes I like, right? Like, okay, or that's the city I want to be in, and the median home price is that price. Okay, that's fine. But we have to figure out what works for them, right? And what's important. If it's payment, it's payment. If it's just want to be in a specific area at a specific price, that's what it is. And then we discuss their employment history. Maybe they're not employed, and maybe they're on a fixed income like Social Security or pension, or military veteran that has disability, right? There can be a multitude of ways to earn income, not necessarily through traditional means, right? Like being employed. Are they self-employed, right? Are they a business owner or 1099, right? Have they been doing that for 2 years? Because general rule of thumb, if you're self-employed, is you need a 2-year history with 2 years of tax returns. Not that there aren't loan programs that don't require that, because there are. But if we're just saying general, right, we try to get an idea of what their work history is for 2 years, whether it's self-employed or employed as a W-2, right, with whatever company or whatever it is.
Right. Okay.
What money they have saved up to use toward their down payment and closing costs, or do they understand that there are closing costs? Right, we have these conversations with them because a lot of buyers don't realize that you do need money outside of just a down payment on the property.
Right.
Now, things are different right now in this market because there's so much more inventory where it's easier to negotiate and get seller credits. So we have those conversations. If it is someone that's like, I have enough for my down payment, maybe it's 3% as a first-time home buyer, I don't have money for closing costs. So we try not to deter them. We always say, hey, it's not uncommon for your agent to be able to negotiate some sort of credit from the seller into your contract that can go towards your closing costs. So I don't want you to feel stuck on that, right? And this is just a conversation we're having. Who's going to be on the loan, of course, is important. Is it just them, or do they have a spouse or someone else that's going to go on the loan with them? It's not uncommon if you have, an individual borrower that may not qualify for the price point that they want on their own to have a non-occupying co-borrower, right? Like a parent or someone who's not going to live in the home, go on there with them to help qualify income-wise. That's something. But these are all things we talk about during that pre-approval call.
Right.
And we do our pre-approvals over the phone. That's something I think that is a little bit different than most lenders. A lot of lenders will have what they call a discovery call with the borrower, find out what their goals are, and then from there send them a link to fill out their own loan application. We can do that. We choose not to because, it's not what they do for a living. And there are things that we may need for the loan application that they don't put on there. And there's things that they may put on there that we don't want, right? So it's easier just to have this conversation. And what I'm talking about can range from 10 minutes to 30 minutes. It depends on how much time they really need, how many questions they have. But at the end of that call, we've gotten to the point where see if they're comfortable to have credit pulled, because that's part of what you should expect if you're going through the pre-approval process. Not a soft credit inquiry, which we can do, but we can't pre-approve someone with a soft credit pull. That means that it doesn't show up as an inquiry.
Right.
A true hard credit inquiry, and for those of you that might be watching this at some point that are scared to have your credit pulled, it's good for 120 days, right? So I always ask clients that I'm talking to get pre-approved, what's your time frame for buying? If they tell me they're looking to buy within that window, then I assure them, hey, we're not going to have to pull your credit again. It's good for the full time frame that you're going to be looking for and then closing on a home. So it's one inquiry. I don't like having my credit pulled, so I understand if they don't want their credit pulled, right? So that's a common thing that we run into. So go through that, get credit pulled, and then there's documents that we need to support the information that we discussed, right? And that's where people confuse pre-approval with pre-qualification. So assuming I stopped where I just said, right, I pulled credit after this conversation, if I issued a letter at that point, that's a pre-qualification because I didn't verify anything.
Right.
Right? We don't do those. We do pre-approvals. So the next step after pulling credit and having this conversation and making sure everything works just based on the information they gave over the phone is we request the documents that would support the information, right? So if they told me that they're a W-2 employee of a company, they have the money in their checking account, right? Then I would get 2 years of W-2s, 30 days of pay stubs, 2 months of bank statements, and their driver's license. It's really not much.
Right.
If they're self-employed and they said, yeah, I've had a business for 3 years, I would get 2 years of tax returns filed, of course, 2 months of bank statements, driver's license. Right. So it's now there are more complicated scenarios where you might need more things than that, but that's a general rule of thumb of what we would need. Once we have those documents, we review them, cross-reference it against the information that we were given over the phone, and assuming everything checks out, we issue the pre-approval letter.
Nice, cool. And then to interject here, as you're going through this process, or if they're about to do that with you, what are like just very briefly, like the 3 or 4 main factors that you as a lender are looking for? You brought up credit. I'm assuming it's income. Is there anything else that people should kind of...
Credit, income, assets, and employment. I mean, that's what all lenders are going to be looking at, right? So do you meet the minimum credit requirements, right? So FHA is typically minimum 580 credit score. Conventional loan, minimum is typically 620. Okay. For minimum credit scores. Employment. Lenders are going to want to see a 2-year employment history. Now, something that people may not know is that let's just say you were in a high school and you graduated and went right into the workforce and you've been working now for a year, we can count your high school as work history to account for the 2 years.
Wow.
Same thing goes for college. If you went to college, graduated from college, got your degree, if you provide a copy of your college transcript showing you graduated and now you've been working even 6 months, we can go ahead and we can actually count college as your work history to account for the full 2 years.
Wow,
right? So
that's so interesting.
They think that they have to wait till they're in the workforce 2 years before they can go ahead and apply for a mortgage. They don't. But so that's your 2-year employment history.
Gotcha.
Talked about the credit. We look at your bank statements to make sure you have money to at least cover the down payment. As I mentioned before, they can get a seller credit to cover closing costs. So if that's going to be the game plan, we at least want to see that they have money to cover their down payment in their bank account. If they don't have it in their bank account, because they're going to maybe get a gift from a family member, which is more common than people realize, right? People are lucky enough to have a family member, like a parent, aunt, uncle, who's able to give them money they're not expecting back, right? A gift to use for their purchase. That's something that we see. So if that's going to be the source of the down payment, then we'll go ahead and we'll get proof of that from whoever the gift donor would be.
Gotcha.
Get their bank statement showing that money. And then income, of course, right? We'd be looking at either the tax returns if they're self-employed or the W-2s and pay stubs to verify what their income is. Are they hourly or are they on a salary? Do they earn commission, bonus, right? All those things need to be considered, and they're all calculated in different ways.
Gotcha. Okay. And since you talked about, income and everything, I know I texted you the other day to ask this, which I've used for, a couple of my buyers already just to have conversation with them. To afford like kind of the barrier of entry, or let's say it's like the average home price around here, $550,000. I know there's more factors that go into it, but what is the income that a household would have to bring in to afford a home like that, roughly?
Yeah, so down payment's going to play a part in that, right? And other liabilities that are on credit. But a $500,000 property, let's just say someone put 5% down, so they're putting down $25,000, they're borrowing $475,000. Their principal and interest payment on that's probably around $3,000, and then they're going to have taxes. Let's call taxes another $600, so we're at like $3,600. They're going to have insurance, call it $300. Let's call it $4,000 plus mortgage insurance because they're putting less than 20% down, right? Call that another $200. You're at $4,200. Just simple math, they'd have to make at least $8,400 a month, assuming they had no other debt and they had excellent credit to qualify for that payment.
Wow. Okay, that's super valuable to know.
What is that, around $100,000 a year, roughly?
Yeah. 1 to like 110. Okay, cool. Cool, man. Well, that was extremely helpful. I want to end with just a little bit of like expert advice, I guess. What is a consistent mistake, or even the number one mistake that you're seeing buyers make when it comes to financing and getting into it, whether it's the first home or the second or third?
I always say, it sounds stupid, but it actually, the biggest mistake that I see first time buyers make is not asking if they qualify for any sort of first time home buyer incentives, because there are programs out there that a lot of people qualify for when they're buying their first home. that they don't even realize exist. And most lenders aren't going to go out of their way or don't even know to mention these things to people. The way we've trained our team is if the minute someone tells us they're a first-time home buyer, our team knows that they check to see if they're eligible for a first-time home buyer grant. That's strictly based on your current home address, right? It's pretty unique. It gives $4,500 towards down payment and closing costs. You don't have to pay it back, which is pretty awesome. So that's the difference between a grant and a bond. Bond you pay back, grant you don't. So it's solid. So that's one of the first things that our team does. Hey, you're a first-time home buyer. Let me see if you're eligible for this first-time home buyer program. We get their current address. We check it in our system, see if they're eligible. And if they are, it changes the trajectory of that phone call because now the person's excited that they qualify for this throughout that call, right?
Gotcha.
But that's a huge mistake. That's a first-time home buyer mistake. It's for any type of buyer, changing from being a W-2 employee to being self-employed is a big mistake some people make, right? Attorneys, it happens with often where I'll pre-approve someone and they worked for a law firm and then they tell me, oh, I just went out on my own. Well, that's a problem because, as I mentioned earlier, for self-employment, just general rule of thumb is you need a 2-year history of being self-employed. And so if you can't provide 2 years of tax returns showing that self-employment, well, now you just killed your loan, right? Or ability to qualify for a loan, I should say. So those are the two biggest mistakes.
Okay.
The first one is the first-time home buyer one, just because they don't really know any better. Actually, one other thing I want to point out, I can keep adding to this.
That's fine, yeah.
Yes, right? Is not understanding like the buyer broker agreement, right? So, I know you don't operate this way, but unfortunately there's a lot of agents out there that take advantage of people.
Of course, yeah.
And so we just ran into this actually on a transaction where I don't get the buyer broker agreement from the client when someone goes under contract. That's between the agent and the client, right? They'll send it to title for compensation purposes, but it's not something we're concerned with unless the buyer's having to pay the broker, right? Well, we just had a situation where the seller on the property was compensating the buyer's agent 2.5%. Get to the closing tape, or right before the closing disclosure went out, and it showed that the buyer was compensating the buyer's agent 2.5%. The seller was compensating the buyer's agent 2.5%, right? So 5% to the buyer's agent. And so the client was like, oh, you didn't tell me I had to pay that I had to pay this $13,000. I'm like, you don't have to pay that. That doesn't even make any sense. The seller's paying it already. Turns out he signed a buyer's broker's agreement with this realtor for 5%.
Oh my goodness. What a shady agent.
Isn't that crazy?
That's wild.
Yeah. And so I would say a mistake is not understanding what you're signing.
Makes
That
sense.
applies to a first-time home buyer or to someone who's bought multiple properties. Read what you're signing. If you don't understand it, ask questions about what you're signing. Don't just sign without getting the answers. Otherwise, you could be in a position like this buyer was, where he got stuck paying that. He signed the agreement, and the agent wasn't willing to, change it, and he got stuck paying that extra $13,000.
That's nuts.
So, just keep those things in mind.
Right. All right.
As a buyer.
Before we hop off, what is like one word or one quick phrase of just some advice that you would give to somebody going out and buying a home this year in the South Florida market?
Ask for a seller credit.
Boom. Got it. Ask for a seller credit. Brandon, I appreciate you. This was awesome.
Absolutely. Yeah, it's my pleasure, AJ.
Yeah, for sure. That wraps up this conversation. I hope it was valuable. I know it was valuable. To reach out to me or Brandon for anything that you need as far as getting a home loan or purchasing a house here in the South Florida market, all of our contact details will be in the description of this video. We'll see you in the next one.